Welcome to the Macro and Flow podcast by Orestes Capital, where we provide a weekly market analysis and guide to our listeners on what we saw and where we're heading. We're Elena and Marcus. Today is May 10th, 2026.
And it is a pretty critical moment for anyone managing capital right now. I mean, if you've been looking at your screens over the past few weeks, you already know the tape has just been totally relentless.
Oh, absolutely relentless. And imagine driving a sports car right where you've got the engine pinned completely in the red.
Right.
You aren't accelerating anymore, but if you even tap the brakes, the engine just violently seizes up. That is exactly where global markets are sitting today.
Yeah, that's the perfect way to visualize it.
Yeah.
Because the headline indices out there are painting this picture of unbroken prosperity.
Yeah.
But what is happening under the hood, the actual mechanical reality of how this market is functioning right now, is a totally different story.
And frankly, it's a story that should have every institutional allocator listening to this on high alert.
100%. Which is our exact mission for today's deep dive. We are delivering a really high-density readout of our proprietary OCM factor trends, and we're going to contrast those internal signals directly with the prevailing street consensus.
Because for you out there managing risk, you are navigating a market that has officially crossed this threshold into absolute growth euphoria.
Yeah, pure euphoria. And we really need to deconstruct the underlying liquidity plumbing that is keeping this whole thing afloat.
Right. We have to look at the retail option frenzies that are distorting the surface level tape. And most importantly, we have to map out the critical tail risks that are quietly building just under the surface.
Because if you are managing capital right now, you really can't afford to just, ride the wave without knowing exactly where these structural fault lines are buried.
You just can't. You have to look past the financial television headlines and dig into the objective truth of the data. And for us, that objective truth is always found in the outputs of our OCM principal component analysis model.
Right, our PCA model. And when we look at the current regime map, the macro environment is firmly cemented in what we classify as a reflation regime.
Reflation, right.
But the primary growth engine itself is what demands our immediate attention today, because it has officially accelerated into a state of pure euphoria.
Well, before we start throwing around terms like PC1 and Z scores, let's ground this a bit for the listener. Because euphoria is a loaded word. It gets thrown around pretty casually to describe, frankly, any green day on the S&P.
Yeah, exactly. Everyone loves to say the market is euphoric.
Right. But in our proprietary modeling, it actually has a very specific, strict mathematical definition. So for the listener trying to visualize this principal component analysis, how exactly does this model strip out the noise of thousands of global assets to find this one undeniable growth signal?
Well, it's a really crucial distinction to make. I mean, financial markets generate literally millions of data points every second. Stock prices, bond yields.
Currency fluctuations.
Yeah, commodity futures. And honestly, most of that is just noise. It's idiosyncratic movement based on maybe a single company's earnings report or, a localized weather event disrupting a supply chain.
Right, it's noise.
Exactly. So what principal component analysis does is it's a mathematical technique that takes all of those thousands of seemingly unrelated variables and it finds the hidden underlying forces that are moving them all at once.
So it's basically isolating the signal.
Yeah, imagine looking at a massive chaotic flock of birds in the sky. If you try to track every single bird, you just get completely overwhelmed by the chaos.
You can't do it.
Right. But if you apply an algorithm to find the center of mass and the primary direction of the entire flock, you find the principal component. That's what our model does for the global economy. It isolates the absolute core axis of movement.
Okay, so we are stripping away the story of any individual stock. We're looking purely at the gravitational pull of the entire macro system, which brings us directly to our first factor, right? Principal component 1, or PC1, which tracks global growth. Where exactly is that core axis sitting right now?
So PC1 is currently sitting at a Z-score of plus 1.42.
Wow.
Yeah. And to put that in perspective for you, a Z-score measures how many standard deviations a specific data point is from its long-term historical mean. In a normal distribution, most of your daily life happens within one standard deviation.
Right, normal everyday market activity.
Exactly. So a reading of plus 1.42 places us in the 95.6th percentile historically.
So wait, the 95.6th percentile, that's not just a strong market. That is a straight-up statistical anomaly.
It is. We are operating in the extreme upper tail of historical growth expectations right now. The market is pricing in an economic expansion of a magnitude that we rarely ever see outside of post-recession recovery spikes.
And here's where it gets really fascinating to me when we look at the dominant loadings in this model. Basically, the specific assets doing the heavy lifting to create this massive growth signal. It isn't necessarily the AI software names everyone is obsessed with on Twitter. The model shows this growth factor is heavily tilted toward the physical, gritty global economy.
Absolutely. It's very physical.
Right. We are seeing a massive loading in copper at plus 0.325. We're seeing the MSCI Emerging Markets Index loading at plus 0.273. And the Australian dollar to US dollar across the AUD/USD is loading at an incredible plus 0.366.
Which is huge.
It is. And that just screams global cyclical growth to me, not just a localized tech boom in Silicon Valley.
And that right there is the hidden architecture of the current tape. It's a highly synchronized move in the physical world. When you see copper and emerging markets and the Aussie dollar all moving with that kind of velocity and deep correlation,
it tells you something fundamental is happening.
It tells you the market isn't just buying a future vision of artificial intelligence. It is actively pricing in a massive, globally coordinated industrial expansion right here, right now.
Because copper is the ultimate barometer for industrial demand, right? I mean, you cannot build infrastructure or data centers or electrical grids without massive amounts of copper.
You literally can't. And the Aussie dollar is basically the ultimate proxy for global commodity exports and Chinese credit expansion. And then you have emerging markets representing the high beta play on global trade volumes.
So the PCA model is basically seeing the physical global growth engine running at absolute maximum capacity.
Exactly.
I do want to pause on the Australian dollar for just a second, though.
Yeah.
Because I know some listeners might wonder, well, why is a currency pair driving a global growth factor?
Yeah, that's a good question.
It's because Australia is essentially the world's mine right. When the global economy wants to build something, it buys iron ore and coal from Australia. So a surging AU/USD cross isn't about Australian domestic policy.
No, not at all.
It's the market's purest tell that the global manufacturing cycle is accelerating.
That's exactly the right way to frame it. I mean, currencies often sniff out the truth way before equity markets do.
Why is that?
Because they're tied directly to the actual flow of physical trade and sovereign capital. The currency market is screaming at us that the demand for raw materials is surging globally.
But, and there's always a but, that physical demand brings a massive complication. Which leads us to the second factor in our model, right? PC2.
Right. Rates and reflation.
Exactly. Now, the narrative out there, the one you hear on every financial network every single morning, is that the market is rallying because investors are anticipating aggressive rate cuts from central banks.
Yeah, that's the story they're telling themselves.
But a PC2 factor is surging to a z-score of plus 0.72. That places it in the 80.2nd percentile. The market is entirely pricing in structural reflation, not easing.
And this right here is the most critical disconnect between the street narrative and mathematical reality. The prevailing consensus is still desperately clinging to this idea of an immaculate soft landing.
The Goldilocks scenario.
Right. A scenario supposedly engineered by central banks, gently lowering the cost of capital. But the OCM-PCA model is explicitly telling us that the reflation trade is back with an absolute vengeance.
Because the growth we just discussed in PC1 is running so incredibly hot that it's actually reigniting structural inflation pressures.
Exactly. And the drivers of that PC2 factor are undeniable if you look at the data. It is being driven intensely by German 10-year yields with a dominant loading of plus 0.501. And U.S. 10-year yields are loading at plus 0.434.
So the global bond market is waking up. Yields are pushing higher across the developed world.
Because bond investors are looking at this hot economy and demanding more compensation for the risk of holding long-term debt.
Right. The bond market is the ultimate arbiter of macro reality.
Always. I mean, equity markets can dream all they want, but bond markets actually do the math. When both German and U.S. 10-year yields are loading that heavily into the reflation factor, it signifies that the era of cheap, abundant capital is being aggressively priced out.
The cost of money is rising precisely because the physical growth engine is demanding so much of it.
Right. So we have growth in the 95th percentile, and we have global interest rates pushing aggressively higher.
Okay, so if I am looking at that setup logically, I would assume we are seeing just a string of absolutely mind-blowing macroeconomic data releases, right? Like non-farm payrolls adding 500,000 jobs a month, GDP prints doubling estimates, massive earnings beats across the board.
You would think so.
But when we actually look at PC3, The economic surprise factor in our model, what does it actually show?
It shows practically nothing.
Nothing.
Nothing. PC3 is currently registering as pure statistical white noise. There is absolutely zero significant tactical signal on either the 26-week or the 52-week horizons.
That's crazy.
The economic data coming out is fine. I mean, it's solid. But it is not consistently surprising to the upside in a way that mathematically justifies the violent euphoric move we are seeing in that PC1 growth factor.
Hold on, though. That creates a massive paradox. If the economic data isn't surprising anyone and the actual cost of capital is going up, why is the tape ripping? How does a market reach the 95.6th percentile of historical growth pricing without the fundamental data to back it up?
Because the tape has completely detached from the macroeconomic calendar. It is running on pure momentum and mechanical positioning rather than fundamental data beats.
So it's just flows.
It's all flows. Investors are buying because the market is going up. And the market is going up because systematic algorithms and retail flows are just blindly allocating capital into the trend. It has become a completely self-referential loop.
The price action itself has basically become the fundamental thesis for the next marginal buyer.
Exactly.
I want to push back on this model output a bit, though, or at least how we interpret the danger of it, because we really have to distinguish between the state of the market and the impulse or the flow, right?
Right, state versus impulse. Very important.
So the state is euphoric. We established that it's at the 95.6th percentile. But let's look at the weekly impulse. The actual rate of change in that PC1 growth factor, the DPC1.
Yeah, the derivative.
It was only plus 0.40 this past week. That puts the impulse in the 68.9th percentile, which honestly is normal. It's arguably healthy. It is certainly not a blow-off top.
Right, that's not.
Because a true blow-off top in our modeling requires a DPC1 greater than plus 1.48. So to go back to the hook of this discussion, isn't this exactly like an engine running completely in the red line, but the driver has stopped pressing the accelerator? The speed is terrifying, but the acceleration has normalized.
That is the perfect mechanical analogy. The RPMs are totally maxed out, but the forward acceleration has stabilized. The vehicle is moving at an incredible, highly dangerous velocity, but it is no longer gaining speed at an exponential rate.
The weekly flow of new money into the growth trade has just moderated to a normal historical level.
Yes.
Right. So if we haven't seen that final exhaustive blow-off top impulse, that massive plus 1.48 spike that usually signals the absolute end of a frenzy, doesn't that mean we're relatively safe for now?
Well,
Because the consensus out there would argue that a normal impulse means the market is digesting its gains constructively.
that's what they're saying. It.
Or does this actually mean the market is structurally vulnerable? Because if you are already in the red line, even a slight negative impulse, just a bump in the road or lifting your foot off the gas by a fraction of an inch, could cause the entire engine to seize.
It is unequivocally the latter. The consensus interpretation of a quote-unquote normal impulse at these extreme altitudes is a fatal miscalculation.
Really? Fatal.
Absolutely. Being in the 95.6th percentile for growth without a massive blow-off impulse means the market is basically sitting on a precarious high-altitude plateau. It is structurally exhausted.
So there's no room for error.
The threshold for disappointment is practically non-existent. When you are priced for absolute perfection in a self-referential momentum loop, is the only thing keeping you suspended at that altitude. All it takes is for the weekly flow impulse to simply turn negative.
Dude, you don't even need a disaster. You don't need a bank failure or a massive geopolitical shock.
No, you really don't. You just need a slight outflow. You just need the marginal buyer to hesitate for a second. Because the structure of this market is incredibly fragile. It requires constant elevated capital inflows just to maintain its current state.
And if it doesn't get them?
If that impulse drops below zero, the gravity of being in the 95th percentile simply takes over. And it triggers a violently fast mean reversion.
That is a terrifying image if you are caught on the wrong side of the trade.
Which brings us perfectly to our next major theme, which is investor positioning and flows.
Right. Let's look at the actual money. We need to see who is actually driving this capital and inflow, who is providing the momentum, and honestly, who is holding the bag. We have the objective truth from the OCM factor trends. Now let's pivot to the market intelligence and look at the consensus across the street.
And the street narrative is universally focused on the S&P 500 right now. I mean, they're constantly noting it's up 16% since the late March bottom.
Yeah, they are all tracking this massive trend channel established all the way back in October 2022. Every research desk across the street is drawing these perfect parallel lines on their charts, showing this methodical, unshakable grind higher.
Yes, the street is extremely comfortable right now. The trend has been their friend for over a year and a half. And when you look at institutional positioning, it really reflects that deep-seated comfort.
Give us the numbers on the institutional side.
Aggregate equity positioning for both discretionary and systematic strategies currently sits at a 3-month high. It's in the 61st percentile overall, with systematic strategies specifically sitting at the 64th percentile.
Okay, so let's interpret that 61st percentile. They are long, they're clearly participating in the rally, but they aren't necessarily maxed out, right? They aren't fully levered.
Right, bridge room.
Market intelligence suggests there is actually still plenty of room for institutional macro managers to increase their exposure. They haven't reached the absolute euphoric extremes we saw, say, last January. They're just methodically adding risk as the trend channel holds. It seems rational almost.
From their perspective, it is rational.
Duh.
The institutional side has been a very methodical climb. They are participating, but their internal risk models are still dictating some level of constraint. They have cash reserves.
But
That methodical, almost academic institutional behavior is completely overshadowed when you look at the sheer violence of the retail tsunami that just hit the market.
the retail numbers we are seeing are genuinely staggering. Let's give the listener the sheer scale of this flow. Retail investors poured a record $190 billion into equity funds globally in April alone.
It's an astronomical number.
Just sit with that number for a second. $190 billion in a single month. And here's the part that really exposes the plumbing. A massive component of that flow, an estimated $100 billion of it, was derived purely from the rebalancing of leveraged ETFs.
Yeah, we really have to unpack that $100 billion leveraged ETF figure extensively, because it is the central key to understanding the market plumbing right now.
Walk us through it.
Well, leveraged ETFs are structured products, right? They are designed to deliver 2 or 3 times the daily return of an underlying index. But to do that, they have to mathematically rebalance their exposure at the end of every single trading day. It's a rigid mandate.
Walk us through the exact mechanical plumbing of that rebalancing. Because I think a lot of people just assume a 3x ETF buys a stock and just holds it on margin. But it is much more dynamic and honestly insidious than that.
It's entirely dynamic.
Yeah.
So let's say a 3x leveraged ETF starts the day with $1 billion in assets. It uses swaps and derivatives to get $3 billion in market exposure. Now, let's say the market goes up 2% that day. The ETF's exposure obviously grows. But to maintain exactly a 3-to-1 leverage ratio for the opening bell tomorrow, the fund manager cannot just sit on their hands.
Because the ratio is out of whack.
Right. Because the asset base has grown, they are mathematically forced to go into the market at the end of the day and buy more of the underlying assets. They literally must increase their gross exposure to keep the ratio perfectly aligned.
So in a market that is just constantly grinding higher day after day, these funds are basically forced to continually buy more stock at the closing bell.
Every single day.
Regardless of valuation, regardless of the macro news, regardless of anything, it creates this mechanical, blind, price-insensitive bid in the market.
Precisely. It is a massive pro-cyclical force. When the market goes up, the math forces them to buy, which pushes the market even higher.
Yeah.
But, and this is the terrifying part, it works in reverse too.
Right.
If the market drops, they are mathematically forced to sell to delever, which pushes the market lower. Right now, because of the relentless upward trend channel, that $100 billion represents a massive mechanical tailwind. But it is entirely devoid of fundamental conviction.
Right, it's just math. Well, if that $100 billion is moving blindly based on math rather than fundamentals, it must be leaving massive footprints in the market.
Huge footprints.
And that leaves the other $90 billion of discretionary retail money. Where is that going? Because I am looking at the flow data, and it is certainly not going into diversified utility stocks or defensive consumer staples.
Well, far from it.
Yeah.
We are seeing a hyper-concentrated catch-up trade. You have to remember, retail investors largely sat out the initial stages of this rally back in March and early April.
Right, they were scared.
They were fearful of the inflation data. They were fearful of the Fed. Now watching the tape just rip higher day after day, their confidence has been forcefully reinstated.
Total FOMO.
Classic FOMO. And they are pouring that discretionary capital into the market with a massive, almost singular preference for the AI and memory semiconductor theme.
Let's actually name the specific tickers dominating our market intelligence, because the flow anomalies here are wild.
They really are.
SanDisk ticker SNDK is showing a massive 4.5 z-score flow anomaly. Micron MU is at a 2.4 z-score. Intel INTC at 2.0.
Yeah.
And it is not just single stocks, right? It's the retail ETFs.
Okay.
The leveraged tech hardware fund, SOXL, and specific DRAM-focused funds are seeing incredible record-breaking volume. Retail is just completely enamored with the physical infrastructure of artificial intelligence. They are buying the memory chips.
You're buying the picks and shovels of the AI gold rush. But they are buying them at flow volumes that are statistically unprecedented. I mean, a 4.5 z-score float anomaly on a major tech stock is an event that should happen less than a fraction of a percent of the time in a normal distribution.
It's an extreme crowding effect.
Extremely crowded.
This brings me to a deeply skeptical question, though. Think about the timeline we just laid out here. The institutional money has been methodically grinding higher since October 2022. They're sitting comfortably in the 61st percentile.
Right.
Retail investors, on the other hand, stayed on the sidelines out of fear. Now at the absolute top of the trend channel with our PC1 growth factor screaming at the 95.6th percentile, historically, retail comes rushing in with a record $190 billion hyper-concentrated in literally 5 memory stocks and heavily reliant on leveraged ETFs.
Yeah.
Are these retail investors essentially acting as peak cycle exit liquidity for the institutional macro managers?
I mean, it is the absolute most vital question we can ask when analyzing these flows. When you look at the stark divergence in behavior, the data strongly suggests a massive transfer of risk is occurring right now.
From institutions to retail?
Yes. Institutional positioning is above average, but it is not at a breaking point. Because they methodically built their positions over a year, they now have the capacity and the liquidity depth to basically sell their holdings into this blinding retail strength without destroying your own performance or collapsing the bid.
You're scaling out while retail scales in.
Exactly. Retail, by contrast, is exhibiting classic late-cycle fear of missing out. They are buying the most volatile, highest beta assets at the exact mathematical moment. Our models show the growth regime is stretched to its absolute historical limits.
It is honestly like watching passengers on a cruise ship. Think about it. The institutional money has been evenly distributed across the decks for a year and a half, keeping the ship perfectly balanced in the water.
Right.
But suddenly a rumor spreads that there is something amazing to see on the starboard side, the AI memory trade. All the retail passengers rush to the starboard side at the exact same moment. What happens to the structural balance of the ship?
It lists heavily to one side.
Exactly. It becomes top-heavy and incredibly susceptible to a rogue wave.
And the danger goes beyond just the tilt of the ship. To expand on your analogy there, modern cruise ships have automatic stabilizing systems, right?
Yeah.
Huge fins under the water that adjust automatically to keep the ship level.
Right.
In the financial markets, those stabilizers are the market makers and the options dealers. But in this specific scenario, because of how derivatives work, as the ship tilts violently to one side, those mechanical stabilizers are mathematically forced to pump more water into the tilting side to hedge their own risk.
Wow. So they actually make it worse.
They actually accelerate the capsize. We're going to get into the exact dealer mechanics shortly, but the key takeaway is that the balance is completely gone. And in this market, the rogue wave that threatens to capsize the vessel is the macroeconomic backdrop, specifically the shifting dynamics in sovereign yields and central bank policy.
Which brings us perfectly back to our third major theme, the macro and policy backdrop. Let's look at the tension between the OCM-PC2 factor, the rates and inflation signal, and the broader economic reality out there.
It's a huge tension.
Because the street consensus is behaving as if the conditions that birthed this massive equity rally back in 2023, specifically the assumption of imminent aggressive central bank rate cuts, they're acting like that's still in place.
Yeah, they're trading ghosts.
But the OCM factor trends prove that the historical tailwind from falling rates has completely evaporated.
The environment has fundamentally changed, but equity positioning just hasn't adapted at all. Growth is exceptional, yes. We proved that with PC1. But the cost of capital is no longer providing a safety net.
Not at all.
The OCM model is explicitly expecting yields to rise further. We actively project the U.S. 10-year Treasury yield to push higher by 5 basis points in the near term. Now, that might not sound like much to a retail stock trader playing options.
Right, 5 basis points sounds tiny.
But in the fixed income world, it represents a continuation of a deeply, deeply painful trend.
And if you look at the consensus across the street, the momentum-based systematic investors, specifically the CTAs, the commodity trading advisors, they are struggling violently with this reality right now.
The CTA behavior is incredibly telling. These are pure algorithmic trend followers. They don't read the news. They don't listen to Fed press conferences. They just follow price momentum.
So what are they doing?
Well, market intelligence shows that these algorithms were briefly long on U.S. Treasuries and UK gilts earlier this spring. They assumed the inflation data would cool and rates would fall. They built massive positions anticipating a huge bond rally.
But that didn't happen.
No. As the reflation reality took hold and the data proved inflation was actually sticky, that trend just broke. The algorithms were forced to rapidly liquidate those longs and violently shift to short positions on global sovereign debt.
They're just getting totally whipsawed. How exactly does a sophisticated algorithm get trapped in a market like this?
Because trend-following algorithms rely on clean breakouts. When market is ranging, meaning it's moving up slightly, then down slightly, but slowly drifting higher in yield over months, the algorithm constantly gets false signals.
It's a death by 1,000 cuts.
Exactly. It buys the dip. The dip keeps dipping. It stops out. It shorts the market, rallies. It stops out again. They're just getting chopped up trying to capture returns in what has basically become a highly frustrating range-bound yield environment that is stubbornly anchored by structural inflation.
And this higher yield environment creates a massive glaring conflict with where the consensus is currently deploying capital in the equity markets.
Oh yeah, a huge conflict.
Because the street reports show an absolute deluge of demand for global equities. Over $200 billion gathered in just 6 months, and a huge disproportionate portion of that capital is flowing into emerging market themes.
Yes.
People are aggressively buying emerging markets as basically a derivative play on the AI hardware supply chain. For example, Korean equities via the EWY ETF currently account for 10 to 14% of all global equity ETF volume.
Which is wild.
That is absurd concentration for a single emerging market index.
It is an astonishing misallocation of capital based on a completely misunderstood narrative. The consensus believes they are buying the manufacturers of the AI revolution.
The logic seems simple, right? Korea makes memory chips. AI needs memory chips, therefore buy Korea.
Right. It's a very simple, seductive micro-narrative. But the OCM factor trends actively and violently conflict with this positioning. Our internal conditional return modeling suggests that right now in a reflation euphoria quadrant, we should be actively tightening our stops on emerging market equity.
Wait, so we're not buying it?
No,
Why?
we actually project a negative 0.34% drag on EM equities over the next 4-week horizon.
So let's force a synthesis for the listener here. The street is aggressively blindly buying EM ETFs like Korea to play the AI hardware boom. They think they are buying a secular, multi-year tech story.
Yeah.
But the OCM PCA model is screaming that we are in a macro-reflationary regime where rising global rates and a strengthening U.S. dollar will act as a crushing headwind for EM equities.
Right.
Who is on the wrong side of this trade, and more importantly, why? Let's unpack the exact mechanism of that.
The street is definitively on the wrong side. And they are on the wrong side because they are totally conflating a micro-narrative with the macro reality. The mechanism of why emerging markets suffer in this specific environment comes down to the plumbing of global corporate finance.
Okay, let's hear it.
Think of it from the perspective of a major Korean corporation. They often borrow heavily in U.S. dollars because the dollar is the global reserve currency, and dollar debt markets just offer way deeper liquidity.
Sure, making it cheaper to borrow.
Right. However, their physical revenues, the money they actually make from selling goods domestically or to non-U.S. partners,
Right.
is largely in their local currency, the won.
Ah, so they have a massive currency mismatch on their balance sheet right there.
Exactly. Now, what happens when U.S. Treasury yields rise? Global capital flows out of riskier emerging markets and floods straight back into the United States to capture that higher risk-free return.
Okay.
This massive capital flight causes the U.S. dollar to strengthen significantly against the Korean won. Suddenly, for our Korean corporation, without their core business changing at all, the local currency cost of servicing that dollar-denominated debt skyrockets.
It just eats their cash flow.
It acts as an invisible wrecking ball on their profit margins. Furthermore, a strong dollar tightens financial conditions globally, making it way harder for these EM economies to roll over their debt in the first place.
So the AI narrative might actually be absolutely true over a 5 to 10 year horizon. They will sell more chips. But over a tactical 1 to 3 month horizon, the rising cost of servicing their debt due to the strong dollar will completely overwhelm the semiconductor growth story in those specific indices.
Precisely. That is the ultimate danger of thematic investing without respecting the macroeconomic plumbing. You can buy the absolute right fundamental story, but if you buy it in the wrong macro regime, the structural currents will drown you, and you will still lose money.
And speaking of plumbing, if that $100 billion of retail flow is moving blindly based on math rather than fundamentals, it must be leaving footprints in the options market too.
Oh, absolutely. That's where it's most visible.
Let's look at the volatility surface and dive deeper into the structural and technical dynamics, because this is where the fragility really shines. Market intelligence points to ETF trading volume just surging out of control, while at the exact same time, the VIX, the market's primary fear gauge, remains heavily compressed.
Yeah, it's practically flatlining.
It is sitting down in the mid-teens, signaling absolute unshakable complacency.
And this volatility compression is a classic symptom of a market being driven by structured products and retail call buying, rather than a genuine fundamental assessment of risk.
Mm.
When we look at the data, retail option trading share is hitting new all-time historical highs.
Unprecedented levels.
And it is almost entirely concentrated in the technology sector. They are not just buying the underlying tech stocks outright, they're aggressively buying out-of-the-money call options. And this behavior fundamentally alters the mechanics of the market.
Now, the term gamma squeeze gets thrown around on Reddit and financial Twitter constantly. But let's actually define the dealer mechanics here for the listener. When a retail trader buys a call option on a memory stock, what exactly happens on the other side of that trade?
Good question. When a retail trader buys a call option, they are buying it from a market maker, also known as a dealer. The dealer's job is to provide liquidity, not to take directional bets on the stock.
They want to stay neutral.
Right. So when the dealer sells that call option, they are now exposed. If the stock goes up, the dealer loses money. To protect themselves, to hedge their delta, the dealer is mechanically forced to go into the open market and buy shares of the underlying stock.
And this is exactly where the squeeze happens.
Yes. As the stock price rises, the sensitivity of that option, its gamma, increases. This mathematical acceleration forces the dealer to buy even more of the underlying stock as the price goes up, just to remain perfectly hedged.
So it's a feedback loop.
It is. Retail buys calls, which forces dealers to buy the stock, which pushes the stock price up, which forces the dealers to buy even more stock. It creates an artificial self-fulfilling upward spiral that has absolutely zero connection to the company's actual earnings or valuation.
And because this retail flow is so incredibly concentrated in just a few memory and AI names, it funnels literally all available liquidity in the broader market into an increasingly narrow corridor.
It's sucking the oxygen out of the room.
We track what we call the investable subsectors funnel, and it is narrowing dramatically. The rising tide is definitely not lifting all boats. Tech and AI software names are up 35 to 55% since early April.
They're acting like a supermassive black hole,
Sucking in every available dollar of speculative capital and dealer hedging flow. Meanwhile, you look at a sector like financials, and it is a completely different universe. Financials are hitting record lows relative to the S&P 500.
The divergence between the haves and the have-nots is stark and honestly deeply troubling. Financials are currently fighting massive secular debates that the broader market is just choosing to ignore.
What kind of debates?
Well, they're dealing with a softening insurance cycle. They are facing the existential threat of private credit aggressively eating into their traditional corporate loan books. And ironically, they're facing the threat of AI itself, which is poised to heavily disrupt their highly lucrative business models in information services and wealth management.
Not to mention the consumer side.
Right. Furthermore, they are getting hit by negative sentiment as rising gas prices and sticky inflation start to pressure the lower-income consumer, which raises the risk of loan defaults. The broad market is completely ignoring these value and cyclical sectors to just blindly chase the gamma-driven momentum in tech.
So we have a market where all the liquidity is funneled into 5 tech hardware stocks. Retail is buying record amounts of call options on those specific names, forcing dealers to buy the underlying, and the VIX is incredibly low.
It's a powder keg.
Let's contrast the street's deep complacency with the OCM house view on volatility then, because our PCA model clearly does not agree with a VIX sitting in the mid-teens.
Not at all. The VIX is pricing in a continuation of smooth sailing. But the OCM model expects a significant violent jump in volatility over the next month. We are actively projecting the VIX to spike by plus 8.84 points and the MOVE index, which measures bond market volatility, to jump by plus 8.34 points.
So our model is mathematically seeing the structural fragility that the options market is just currently choosing to ignore.
Yes.
Let's highlight the profound tension here, because this is where institutional fortunes are made and lost. I go back to the analogy of a tightly coiled spring.
Okay.
If institutional systematic positioning is in the 99th to 100th percentile for momentum, meaning the algorithms are max long, the trend channel in retail is max long call options on 5 memory stocks, creating massive dealer gamma positioning. Isn't the options market fundamentally mispricing the fragility of this specific ecosystem?
Totally mispricing it.
Because the VIX assumes a normal bell curve distribution of risk, but we are looking at a highly combustible, incredibly concentrated setup.
It is severely, dangerously mispriced. The options market is currently pricing in the absolute continuation of the trend, which implies a slow, methodical grind higher with low realized day-to-day volatility.
Right.
But when positioning is this stretched, when every single participant, from the algorithmic CTA to the retail day trader, is crowded onto the exact same side of the boat, the risk profile fundamentally changes. The risk isn't a slow 5% cyclical correction. The risk is a trapdoor.
So what happens when the trapdoor opens? Walk us through the actual mechanical unraveling of that gamma squeeze.
Well, if the narrative shifts, or crucially, if that DPC1 flow impulse we discussed earlier simply turns negative, the entire structure works in reverse. The systematic momentum funds will be mathematically forced to unwind their long positions simultaneously.
They all hit sell at once.
Exactly. As the stock prices start to drop, the options dealers who were previously forced to buy the stock on the way up are now mathematically forced to sell the stock to unwind their hedges. The retail investors, seeing their leveraged ETFs plummeting, will naturally panic sell,
creating a massive coordinated liquidity vacuum.
Yes. Everyone needs to sell at the exact same millisecond, and there are literally no natural buyers left because everyone is already fully invested. The liquidity vacuum that creates will cause a volatility expansion far exceeding what the VIX is currently pricing. The coiled spring doesn't just slowly unwind, it violently snaps.
Wow. Okay. We have mapped the regime, we have tracked the flows, and we have exposed the hidden plumbing. Now we bring this briefing to its strategic climax. Section 5. The pain trade and our outlook.
This is where the rubber meets the road.
We need to define exactly what the consensus is missing and how we deploy capital to protect ourselves. Where is the street most glaringly wrong right now?
The consensus is wrong because it is relentlessly chasing the AI and memory growth narrative under the completely false assumption that we are heading for an immaculate soft landing accompanied by imminent aggressive rate cuts.
They truly believe they are at the beginning of a brand new multi-decade secular cycle.
They do. But the objective truth of the OCM PCA model identifies the 4-week cumulative flow for global growth as, quote-unquote, stretched positive. It is sitting at a plus 0.99 sigma, placing it in the 89.9th percentile.
Meaning?
Statistically speaking, the easy risk-adjusted money in the pure growth trade has already been made.
So if the easy money in tech is gone and the risk of a trapdoor is rising, what is the house view action plan? What does the OCM conditional return table demand we actually do with our capital right now to navigate this?
The true reflation trade, based on our historical modeling of this specific macroeconomic quadrant, is not found in technology. It is found in commodities.
Commodities.
The model dictates an overweight position in Brent crude with an expected 4-week return of plus 6.60%. It dictates an overweight position in copper, expecting a return of plus 1.11%.
So hard assets.
These are the hard physical assets that inherently benefit from a hot global economy and structural inflation. When the global industrial cycle accelerates, you really want to own the raw materials that fuel it, not just the software that runs on it.
Energy and industrial metals. We are buying the physical reality of the economy. And what are we cutting? Where does the model demand we tighten our stops and reduce exposure?
We must immediately underweight or dramatically tighten our stops on emerging market debt, emerging market equity, and U.S. small caps. We discussed the EM mechanics earlier with the strong dollar, but small caps are equally vulnerable here.
Why are small caps so vulnerable right now?
Because small capitalization companies are highly reliant on floating rate debt. As sovereign yields rise and stay higher for longer, these companies face a massive debt wall. They have to refinance their loans at significantly higher interest rates, which directly incinerates their profit margins.
So the liquidity that previously fueled them is actively being drained by the reflationary reality.
Exactly.
And crucially, we must hedge. You don't look at an internal model projecting a VIX spike of almost 9 points and just sit on your hands.
Absolutely not.
The model demands we initiate hedging strategies using volatility products immediately given the imminent expected spike in both the VIX and the many indices. We have an opportunity to buy insurance while the market's complacency is keeping premiums historically cheap.
Right. This severe mispricing in the options market that we identified earlier is actually an opportunity for us. It allows us to hedge the portfolio efficiently before the underlying structural fragility is exposed to the broader street.
This brings us to the ultimate tail risk for the coming week. We have to define exactly what the catalyst for disaster looks like. We are sitting here long growth at the 95.6 percentile historically. That leaves the entire street massively structurally vulnerable to a violent mean reversion, what our internal model formally classifies as a large negative event.
Yes, it does.
And the most terrifying part is that it doesn't take a black swan to trigger it. We don't need a war or a pandemic. What is the actual trigger?
The trigger is simply the exhaustion of the flow. If the wrinkly flow impulse, that DPC1 metric, simply turns negative, if the marginal dollar decides to take profits rather than buy the top bound, the entire momentum structure basically begins to eat itself.
It all unravels.
It is the inescapable gravity of being in the 95th percentile. You cannot stay suspended at that altitude without relentless exponential buying pressure. When the buying stops, the drop is immediate, mechanical, and severe.
That is the defining reality of this market structure. So we leave you, the listener, with this final stark realization.
Yeah.
The massive irony here is that the consensus right now, the retail trader blindly buying the SOXL ETF, the systematic fund, riding the momentum channel, they truly believe they are buying the future of tech. They think they are investing in the year 2030.
But our internal data, the objective truth of the OCM model, shows they are actually just buying the absolute top of a late-stage cyclical inflation trade in the year 2026.
They are trading a micro story, but they are caught in a macro trap. And that fundamental misunderstanding of the regime is where the real systemic danger lies. What if the retail guys are actually financing the institutional exit, but the institutions themselves are trapped because the exit doors are too small? If everyone is a momentum trader who is the fundamental buyer of last resort, nobody.
Exactly. The ultimate pain trade right now isn't missing out on the last 5% of this massive AI rally. The ultimate pain trade is holding the bag when the reality of rising rates finally shatters the illusion of growth euphoria. When the engine in the red line finally seizes, you definitely do not want to be the one who just bought a ticket for the ride.
A critical perspective for navigating the weeks ahead. See you next week, wherever the flows take us.